This is a Momentum Media production.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Welcome everybody to another episode of the Property Nerds podcast. I'm your host, Arjun Paliwal, CEO of InvestorKit Buyers Agency, and has it been feeling good to be on the mic again? It's really, really good to be back in action. And I just wanted to say again, thank you to everyone who's been dropping me messages after I've been away with some intense open heart surgery, now coming to 12 weeks ago. So I'm officially at that intense recovery part behind me. And now it's just a bit of lifting, strength and improvement, that sort of stuff getting better. But yeah, look, I just wanted to say I'm blown away with the messages of support, whether it be WhatsApp, email, phone calls, texts. Thank you all so much. But today's episode, I've got a few cool things to run through. But before we do, there is an announcement coming up. So not on the next episode we record, but the episode after. We've got a new face joining me as the co-host of the Property Nerds podcast. So I cannot wait to share more on that. Now, for those who don't know, the previous co-host was my lovely wife, Lee. She has, joined full-time motherhood, and as a result, the podcast isn't up there with the top priorities right now for her, especially with little Ruby, keeping her very, very busy. And so she's absolutely supporting me, supporting us a lot with her move into that, and she's loving every single bit. So I'm honestly so happy for her and how much she's thriving and enjoying that space and just supporting us as a family with that. And I consider myself super lucky to get that support as well. So that's a big change on the Paliwal household front. But also it means that we've got a new name coming in to help me run the show. And I'm sure everyone's probably sick of my voice in isolation. So it'd be good to have some banter with someone else. And with regards to that new person, they are a finance guru. So we started this podcast in recent times with myself and Lee with the theme of property and finance both coming together. It's very rare you see things transact one without the other. Right, finance plays an important part in the role of property investing. Growing a portfolio, leverage is the name of the game. And I think there's a saying out there, right? Property is a game of finance with a whole bunch of houses thrown around. I don't know if I nailed it right, but it essentially means finance comes first, which in many cases before you buy a place, that is what happens. And so, yeah, it's going to be really, really good to go deep into, the world of finance and property coming together. And that is happening in a couple of weeks from now. So I think end of September, mid-September, we're recording together and that's the kickoff. So end of September, you should see some pretty cool episodes start to fly out with my new guest and play. Now that one is for later. Now in terms of today, I've got a couple of other cool things to share, and that is regarding our latest white paper. So the last white paper we released was the Australian Housing Fundamentals, totally free. And if you're new to InvestorKit and this particular podcast, the Property Nerds, we go through white papers, research papers in more detail. And that research paper is now one of our highest downloaded ones ever. And so it's the Australian Housing Fundamentals. It's a rerun, so we do that every single year. And this one's the Housing Fundamentals for FY 24-25. So if you'd like to go grab a free copy of that, it's investorkit.com.au. And there is loads to uncover in that. So firstly, you'll see fundamentals broken down across demand, supply, and confidence. And with those fundamentals, you see it broken up into, I believe it's like 25 indicators, each having a ranking from, very strong, okay, and weak. And I think that's a point to zone in on because very few housing commentators that are running businesses in property like I am will actually comment on the weak. Because as you know, there's a bias element that property businesses want property to always go well. Therefore, they comment on only what's good. And then you've got the opposite, where you've got the economists or others that come in and they go, hey, stories sell for us either way, so we'd rather be in extremes. And they come in and talk about 30, 40, 50% declines and deep danger. So you've got issues on both ends. Now, hand on heart, I want to say to you, this is a report that isn't the bullish commentator of property markets and isn't the actual person who's bearish either on the other side saying everything's going to fall. you will see every single major fundamental broken down across those three categories of demand, supply, confidence. You see it all with rankings from strong to weak, and you'll actually see the data point behind it, the source of the data behind it. You'll see overall summaries and breakdown as to how we got to them, what's happening in the landscape. And then my favorite part is the best part towards the end, which is the actual market pressure review. So the market pressure with regards to those rankings is here to tell you what's going to happen across those cities, the 8 capitals and the 25 regional centers, the largest ones, across the next 12 months. Now, what's pretty cool here is since this is a rerun of last year's, we actually have the pressure rankings and the growth forecasts we gave for last year across all those same cities. And then we also recap how they actually performed. So you'll get to see accuracy levels, how well were they placed, what went right, what didn't in terms of forecasts. And I hope when you see that, you'll get immense confidence around our forecasting, but also what we see for next year. So again, that's investorkit.com.au. And that's the property research tab. If you click on that part of the website, you'll get that report totally free. So that's a shout out on the last research paper by the research team here at InvestorKit. And today I'm going to go through something that's been really bugging me, actually. So I see a lot of commentary in property markets and property investing, data breakdown. And some of the biggest things that I see an issue with is oversimplification of property investing. And this can actually be an issue because when you oversimplify property investing, you make the story like too good to be true almost. You actually make it just sound amazing, and I think it's too good to be true. And so to give you an example, let's talk about the stories around, how many properties you need, retiring in 10 years, retiring in 20 years, breaking it down in more detail. And one of the most common ones I'm seeing out there often is, hey, 4 properties, 100K passive income, you're done and dusted. So just this oversimplification of data. And that's what I want to make this episode about, getting your math right? So if you take 4 properties, and we're going to use these numbers because it's what I'm seeing out there at 500K prices, and they rent out for $500 per week. Seems like some pretty good numbers. Firstly, 5.2% rental yields. Now, the notion of where these 4 properties came from and how people think that 4 properties equal 100K in passive income and everything's great is that if you do the math of 500 per week in rent times 52 weeks equals 26,000. And then if you times that by 4 equals over 100K in income, right? That is where the issue is straight away. Oversimplification of property data. And I think the dangers of this is that when you simplify it that much, the messaging is really easy. And then the following to that message becomes easier. Because anything that's made into child's play, it allows it to be a concept that they can then be followed. And I think as a result, what people don't recognize is, yes, simplification is great when you understand it deeply, but don't simplify it if the numbers are just out of whack. And this is the importance of getting your math right. And so let me break this down for you in this particular example with the 4 properties at 500 rent per week, 500K purchase prices, and see how that actually gets you to 100K passive income. And firstly, does it or does it not? Now, when I saw this, it was also stating it happened in 10 years. I just want to tell you that that does not happen by just buying 4. So I'm going to give this calculation 20 years to even make it more friendly. Now, firstly, what I did is the first breakdown of where this is an issue is I took out things like rates, water, insurance, 2 weeks of vacancy, 2 weeks of maintenance, and letting fee. And all these bills, by the way, I just used a sort of normalized amount. There can be some cities that are higher for insurance, some properties that are higher for maintenance, and some markets going through cycles that are higher for vacancy. But I said that these things would hit the dollar signs every single year. 8,250 was the metric I took. Now, if you take away that from the initial rent of 26,000, that's $17,750. So immediately at 71K for now the 4 properties is already less than the 100K. And that's now before tax as well. So even if someone handed you those 400 or 500K properties and they handed it to you today and they were all debt free, that 100K number is already incorrect. So firstly, what we should learn here is that we shouldn't oversimplify the numbers, and 400 or 500K properties is not going to do it if the goal is 100K when really they're hitting 71K in today's dollars. Here's the next thing. Hey, Arjun, what about rents? Rents are booming. Rents are going to grow. And therefore, if over the 20 years, those 4 properties will hit 100K. Again, the math is wrong, because you cannot use today's rental data and assume that rental markets will stay this hot forever. So people think they saw today's rental markets and that the boom was really here and the boom will stay. The recent boom is essentially just playing catch up on rents that haven't grown for long. So this is an unpopular opinion I'm about to share. Now, obviously, renting has been very tough in recent times with super tight vacancy rates and rents jumping all across the country. The sad news is, whilst that is scary and has been difficult for many, it's actually just playing catch up, meaning rents were supposed to grow this much to bring back things to long-term averages. And rents have actually gone through so many years of little to no growth. To give it some context, since 2009, in capital cities, as per CoreLogic, rents have only crossed 6% annual growth at 2021 and onwards. That means there's 12 years of below average rent in our capital cities in Australia. So that means, yes, whilst it's super troublesome right now, property owners and investors have actually only seen the recent times of strong growth, 2021 till now. Whereas the 12 years before that, at a capital city national level, they've seen well below average rent. And that is a clear example to say that you cannot think that rents have been booming like this all the time and that your calculations will be the same and based on these figures. So if you take those rental numbers and you go 71K and you take that 71K and you apply 5% per annum growth of rents and compound that, after 20 years, you get about 188K in total rents after expenses. This is sounding much better. But at the same time, we've got to take inflation-adjusted target goals. So if you take 100K income, say in 2003, and use the RBA calculator to get inflation and look at what the number would need to be in 2023, that number is 170K. So this is sounding pretty good, right? The 4 properties initially did not get you 100K in day one, even if they were debt-free, because that was 71K versus the 100. But if you give it some time, not 10 years, doesn't catch the numbers. So anyone saying, yeah, we'll get you 4 properties, 500K, 500 per week rent, let's get them debt-free in 10 years, passive income, forget about it. So now we're looking at a 20-year number and the 188K, which is the after expenses, because we assumed all those expenses, rates, water, insurance, vacancy, maintenance, all crossed the inflation growth as well. That's 188K versus the 170 number, which is 100K inflation adjusted. So good news, right? You cross the 170 mark by hitting 188K in 20 years. So you've got your 100K of today. But here's the next issue. Number one, that's assuming that you had all 4 properties debt-free. How do they get to debt-free? You must have bought 5, 6, 7, 8, waited for growth there, sold, capital gains tax, clear the debts on the 4. You must have been a great saver, not buying anything else afterwards for 20 years. All your offset accounts full. Maybe you're 47 years old and 67 comes around, you got to look at super and you try and use money in super to clear the debts. It ain't that simple. There's a lot of things you have to consider, whether you buy more, whether you save harder, and now it's a 30-year loan that you're trying to get rid of in 20. Or whether you use other assets to clear that debt. That's the first part. It needs to be debt-free. So it's not just your 4 properties anymore. Maybe not even 5 or 6. That's the next part. Number 2 is here's the biggest issue with oversimplification. Since when do you buy 4 properties in one go, all at once? I'm not saying it can't happen, Maybe you have your family home, maybe use the equity there. But if you're starting fresh, you won't buy 4 properties at 500K in day one. All this math was done as if you had the 4 today, and then you gave it 20 years. So one of two things has to happen now. Either the 20-year journey has to actually be 25 to 30 years, because you'll need that 5 to 10 years of time to save up, grow your income, have equity growth, unlock equity, and buy those 4 properties. And then you hold for the 20 years and figure out how you can pay them off with aggressive savings, rent increases, or whatever you need to have. Super, downsizing your home. You can see there's a lot of variables. But the main thing is you need 25 to 30 years now because you need the 5 to 10 years to actually acquire the properties. Or number 2 is that you don't calculate them on a 20-year having them from day one. You calculate them correctly. For example, you bought 1 property in day 1 of your 20-year plan. So now you've got 20 years of rental and compounding growth for that. Then number 2 is you bought a property 3 years later. And so now you've got 17 years for that property compounding. Then the third, you bought in 5 years in total. So that property's got 15 years to compound out of the 20. And then the fourth one, you purchased with 13 years compounding, meaning you bought it from year 7 from your initial days of calculating. So this is an acquisition window of 7 years. Because when people do the calcs on 20, you don't start off with the 5 properties or 4 properties with 500K renting for $500 a week. So it's 4 properties over 7 years. So one has the full 20, the next one has 17, the next one has 15, the next one has 13 years of rental compound growth. So we mentioned earlier that 170K is the inflation adjusted figure that you need using RBA's calculator. 188K is what was achieved if you assumed you had 4 day one and they all had the 20 years, which means you would have been buying over the 25 to 30 year period. That was 188K, so it crossed the 170. Now what's the figure if you start today and you have to buy over 7 years, but you're holding the whole portfolio over 20? That figure is 158K. Not enough. You're under. 12K under. Now for that 12K under, you divide that 158 by 4. It's 40K or 39.5K per property. So you actually need a 5th property, and that needs to be debt-free too, but you probably only got 10 years compounding for that one. So all of a sudden, it's not that simple now, is it? Can it happen? Of course it can happen. We've seen families that we've helped to get 8, 9 properties renting at these amounts in a few short years. But that isn't the position for the majority. So why mislead the majority? Or why have barbecue conversations, well-meaning barbecue conversations, that you're just going to buy 500K times 4, 500 a rent a week, get to 100K passive income and you'll be fine. Sorry, you won't. You'll either need more time, you'll either need more aggression to then sell some, you'll either need properties with higher rents and a combination of the other 2 factors. And you'll need to make sure you figure out your discipline over this whole 20-year period so you can pay off that debt and get it all free. Because having 4 properties is one thing, having 4 properties debt-free is another thing. And yes, even with 20 years. Remember, the banks themselves loan you a 30-year terms. And since when have you seen an investor rushing to pay their loans down? They don't. In the name of tax-free. No, I don't want to pay tax. I need tax. I need to save my tax. So, you don't want to pay tax. I want my deductible debt to be high. I want to save on tax. Okay, well, great. Sounds cool. Great to do it earlier on. But then as soon as you need to draw an income from it, then what? You need to think of that exit plan. So there are so many variables. I encourage you to rewind this so you can make sure you get the math right. Firstly, if I break down this into just a couple of actionable bullet points, number 1, you need time. 20 years is the sweet spot. Number 2, you need to look at rent after expenses, not rent at a gross level, even if the property is debt-free. There can be almost 30% plus of expenses made up in a property that aren't to do with the debt. Then you've got to be conservative with your calcs. That's the third point. You can't just use the booms of today forever. That is not the normal. The fourth point is you've got to consider inflation adjusted for your targets. Can't just say 100K passive income because it's easy to say, 100K in 20 years is probably 170. Then you need to figure out, this is usually debt-free based. So how do I get this debt-free? And then you figure out the final point, that it's not likely you having purchased them all immediately at once. You purchase them over a time period, 3, 5, 7 years. So your goal should be reducing that time period as much as possible, increasing income, savings plans, and financial management, building a team around you so you don't think or overthink so much. Paralysis analysis is huge on your own. Execute intensely for the first 3, 5, 7 years, and try not to make your positioning of buying longer than 7 years if you can. Now, this is residential property. Obviously, if you go down the path of commercial, the number becomes slightly easier with incomes that are higher. But the concept is the same for all the other metrics in terms of time consideration, inflation, rental growth, bills, vacancy, all of that's still the same. So as part of what we do here at InvestorKit, we construct portfolio plans. Now, we can't give financial advice, so they're not holistic about your stocks or investment products or anything like that. They're just property plans. But I say just very loosely because it's powerful. It's not just a property plan, it's powerful. You can use platforms that we provide as part of our service. And in these platforms, you can input your goals. We'll calculate inflation adjusted, where you are today, where you're trying to get to. And the tools can help you reverse engineer. How many properties does it take? How do you go through an acquire phase, a holding phase, then consolidate phase, and actually clear the debts? Our strategists do this day in, day out. And so to get the right math, just jump on investorkit.com.au, request a free consultation. And then if our services are fit, that's the first thing we do when someone's onboarded officially as a client, building portfolio plans for property investors. Wanted to make this note here just to make sure you get your math right. Anytime you're scrolling on the internet, chatting to a mate, at the barbecue, out for dinner, out for a bevy, just a quick beer, anything, get your math right. Do not let someone oversimplify property investments. Oh yeah, just buy a couple and you'll be fine. Buy them, sell that, debt-free, haha, off to the bank, yeah, 100K, me and the missus, 10 years, we're done. We've got passive income. No, it's not that simple. Break down the math. Now, I want one more thing to share with you on another thing I've seen. I told you this was bugging me, just the whole simplification of stuff. It's been bugging me. Remember, I live in this research world. I've got my team who are data scientists, senior research analysts. I don't share that to brag. I share that because we truly live and breathe this. And when we live and breathe this, the simplification stuff is not on. Because we know that when we actually dig deep, it's not the case. You got to go deeper. So here's an example. The final one I'll share with you is land size. Yes, there's measurements of land to asset ratio and thing, but land size, when you isolate metrics, really doesn't matter much. Because the thing with property investing is if you can find the isolated example, that is enough to prove something wrong. You don't have to group things in data because when you're grouping things, there is a big mistake that people make when analyzing property data, and they group things to create an analysis. For example, first quartile, second quartile, next one, or the 20th group versus the first group, and you're investing it across all these groups based on, whether it be available land or land size. Incorrect ways to look at it, because as soon as you can find one exception to the rule is flawed. Because in property investing, humans don't buy quartiles. They don't buy the 20th group. They don't buy an index. They buy one home on one street, in one suburb, in a council, in a city, in a state. We can just keep going here. In a country, in the globe, in the universe. So we're not buying an index. When we buy a home, we are buying a home. And so as soon as you see one asset that has available land near it, or one asset that is smaller in land and it outperforms the other asset that is greater in land size, there is already an exception to the rule, so the rule is flawed. So you can't just keep setting rules. So I'll give you an example, land size. Land size, you should have large land size because land appreciates, building depreciates, and with large land size, you can then outperform. Okay, so then tell me, why didn't you buy that property in Outback Australia for the same price for tens and tens of thousands of square meters, acreage all over the place? Why did you not buy that? It's in your budget. It's a cheap place. It's acres of land. You'll own half of Sydney with a purchase in the Outback. But you don't. because you're seeing the land for its value, not the size. And so in inner West Sydney, there are suburbs where the terraces sit on tiny blocks of land, like 180, 200, and even far northwest of Sydney, 50 kilometers out, 40 kilometers out from the CBD, there are blocks at 275 square meters of land selling like crazy. Now, these are properties on them. So then it made me realize people are willing to pay what they're willing to pay, what their taste is. Some people want low maintenance backyards. Some people want the trendy home. Some people want the amenities around them. Some people want that school. Some people want family and community. Now, yes, even if you isolate those, they don't improve capital growth. Example, if you look at shopping centers or train stations and all these things or great schools, even that alone isn't the capital growth generator that you can rely on. But the thing I'm trying to say is that land size cannot be simplified, or land to asset ratio cannot be simplified as this one metric that does it all for you. And so the key is not to oversimplify data. Because when you start doing that, you make incorrect decisions thinking that you're making the right decision. As soon as there's an exception, the rule is largely flawed. So the rule of large land, get better block size, better, is not correct if all other factors are pointing to people still willing and able and desiring to pay for smaller land in a different area, and the price growth as a percentage outperforms the one with the higher land. That can happen in many cases across many cities. And so as a result, if you just take these 2 points from breaking down portfolio cash flow, considering it from all these angles, and breaking down something as simple as land size, you're on the way to looking at property in more detail, more holistically, and you're on your way to build a greater property portfolio. Like, that's all I want from this conversation. I want you to be able to go out there and just block the simplified noise, block the marketing message that you see. Stop getting into the sounds too good to be true and getting lost into all that stuff. Or the other podcasts where you might like someone as a person. They sound great. They're engaging. They're energetic. They might not be the boring numbers Arjun or the data Arjun guy, right? They might be way more fun. But do not get lost in the oversimplification. Be more informed, make better decisions, and make sure you don't rely on oversimplified rules. That's it from me, Arjun Paliwal, the Property Nerds, and I can't wait to jump on the mic again, but in a couple of fortnights, it'll be with our new co-host, who I can't wait to introduce. It's going to be killer. And we also got a new studio. So whilst this one's an audio only, and the next one's probably audio only too, the one after that will be in the new studio. We'll get videos going up. Check out our YouTube page, InvestorKit, and drop a big subscribe there to be notified for those videos coming up. So for the first time, you can get Property Nerds on the video more regularly. Looking forward to it, and catch you all soon. And thank you, everyone, for tuning in and all your messages to me as well.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.